Hey friends, welcome back to Zalwora, and let's do a proper weekend market check-in, because this week again reminded investors that markets do not move in a straight line, and more importantly, they do not react only to earnings or valuations when geopolitics starts dominating the tape.
If we look at the week honestly, this was a very weak week across most major assets.
The Nasdaq closed around 20,948, down about 5.4% for the week. The S&P 500 ended near 6,369, down about 3.9%, and the Dow closed around 45,167, down roughly 2.3%. In India, Nifty 50 finished near 22,820, down about 4% on the week, while Bank Nifty was even weaker, down roughly 5.5%, which tells you financials were clearly under pressure. At the same time, the VIX rose to around 31, and India VIX moved near 27, which means fear is back in the system, even if we have not seen full liquidation panic yet. Now, what actually happened here? That is the bigger question. For a brief moment, the market tried to believe the de-escalation story. We had those headlines around productive talks, delayed strikes, and maybe some easing around the Iran situation. That gave us a short relief rally. But the problem is, that relief rally did not have deep conviction underneath it. Very quickly, the market started realizing that the geopolitical story is still unresolved. Iran was rejecting direct talk narratives, Hormuz risk was still alive, and oil started bouncing again. That is when risk appetite faded and the selling returned. And this is where oil becomes the central character in the story. When crude stays high, especially in this kind of geopolitical environment, markets do not just see an energy price, they see inflation risk, pressure on consumer spending, pressure on margins, pressure on imports for countries like India, and also a more difficult path for central banks. So, this is not just about one commodity moving higher. Oil is acting like the transmission line for fear across equities, currencies, and broader sentiment. That is exactly why growth assets felt so heavy this week. Tech came under pressure again, the Nasdaq stayed weak, and the broader US technology space also saw clear selling. Big names like Microsoft, Nvidia, Alphabet, Amazon, and Meta all remained under stress, which tells you investors were pulling back from growth and longer duration bets as oil moved higher and volatility picked up. At the same time, energy was one of the very few pockets still holding up relatively well. And that is not surprising because when crude stays elevated, money naturally starts rotating toward that space. Now let's talk about India separately because I think this is important. Nifty at 22,820 is not just a number. It tells you the market has given back a lot of confidence, and Bank Nifty falling harder than Nifty shows that the pressure is not just broad-based nervousness, it is also concentrated in financials, which matter a lot for the index structure. Nifty IT was relatively less weak on the week, but autos were hit, banks were hit, and the broader message is simple. This is not the kind of tape where you aggressively chase random dips just because the market feels cheaper than last week. One more interesting signal this week came from gold and Bitcoin. Gold actually finished the week lower, silver was even weaker, and Bitcoin slipped back into the 65 to 66K zone. That matters because in a proper panic market, you would normally expect safer assets to attract much stronger flows. But that is not really happening right now. So to me, this does not look like a simple fear trade. It feels more like a liquidity and uncertainty market, where investors are clearly nervous, but at the same time, they are being much more selective instead of blindly rushing into every asset that is usually seen as a hedge. Now, coming to sentiment, what is the real mood right now? My reading is this: the market is not comfortable, but it is also not in complete surrender mode. This is why we keep seeing these violent relief rallies followed by equally sharp reversals. The market wants to believe the situation will calm down, but every time there is conflicting news, oil reacts, volatility picks up, and traders de-risk again. So, sentiment right now is best described as cautious, frustrated, headline sensitive, and still risk off.
So, what should investors expect next week? For me, the market is still going to revolve around a few key things. And at the top of that list is oil, the Strait of Hormuz, and whatever fresh headlines come out around that situation. If oil starts cooling in a meaningful way, markets can.
But if oil stays elevated or moves even higher, then pressure can continue across US tech, Indian financials, and broader risk assets. I would also watch volatility very closely because when VIX remains high, it usually means the market is still uncomfortable. And in that kind of environment, even rallies can fade quickly because uncertainty is still being priced in. Now, let me give you my simple strategy view, and I'll keep this very practical. First, this is not the time to go all in emotionally just because prices have corrected. Second, this is also not the time to panic sell everything if your positions are in themes you actually believe in for the next few years. The smarter approach in this kind of market is patience, position sizing, and selective buying only when there is either real confirmation or exceptional value. For short term traders, I would say stay light, stay fast, and respect volatility. In a headline driven market, even a strong green day can get reversed very quickly. For long term investors, this is where cash becomes a position. Holding cash is not weakness. Cash gives you optionality. It lets you buy when there is real clarity or when strong names come into genuinely attractive zones. So, how am I thinking about it personally? I am not looking at this as a panic market, but I am also definitely not looking at this as a market to become aggressive blindly. I would rather stay patient, keep some dry powder, avoid chasing weak rebounds, and focus on areas showing real relative strength. If oil cools and the geopolitical risk premium starts fading, then markets can recover much faster than people expect. But until that happens, I think discipline matters more than excitement.
So, the weekend takeaway is very simple. We just had another weak week. Oil remains the key macro risk. Sentiment is fragile, volatility is elevated, and next week the market will probably continue reacting more to headlines than to fundamentals. Let me know in the comments what you are watching most closely next week: oil, Nifty, US tech, gold, or Bitcoin. And follow me on X at Zalwora because I post regular market updates there. This is for market education only, not a buy or sell recommendation. Have a peaceful weekend, stay sharp, and I'll see you in the next update.